America is not in a recession, at least not officially. GDP is still growing, unemployment is still low, stock markets are still elevated. On paper, the U.S. economy looks stable, but something feels different. Conversations have changed, consumers are more cautious, businesses are more selective, hiring is slowing in key sectors, and recession talk is quietly returning. So what is really happening in 2026? Is America heading into a recession, or is this just a slowdown phase? Let's break it down carefully. GDP growth is still positive, but the pace has cooled. Growth is no longer broad-based, it is concentrated. Government spending remains strong, certain service sectors remain resilient, but manufacturing is soft. Commercial real estate is under pressure. Small businesses report tighter margins. Growth exists, but it is uneven. That matters because recessions do not begin with collapse, they begin with imbalance. Now look at consumers. Household spending has held up, but credit card balances are at record highs. Interest rates on those balances are near 22%. Auto loan delinquencies are rising. Savings rates are lower than pre-pandemic norms. Spending continues, but flexibility is shrinking. When households rely on debt to maintain lifestyle, that is not strength, that is strain. The labor market still looks solid. Headline unemployment remains relatively low, but job growth has slowed compared to last year. Temporary hiring is weaker. Overtime hours are declining in some industries. Corporate layoffs are selective, not massive. Technology, finance, logistics. Companies are protecting margins, not expanding aggressively. Wage growth has moderated. It is still positive, but no longer accelerating. Labor is stable, not booming. Now consider interest rates. The Federal Reserve kept rates elevated longer than many expected. The goal was inflation control. Inflation has cooled from peak levels, but it remains above the long-term target. High rates create pressure. Mortgage costs remain high, credit conditions tighten, business borrowing slows, investment decisions are delayed. High rates do not cause immediate recession. They create gradual friction, and friction builds quietly. Then there is the yield curve. In previous cycles, an inverted yield curve preceded recessions. Short-term rates remain elevated, long-term yields fluctuate. Credit markets are watching closely. Banks are cautious. Lending standards remain tighter than normal. Credit tightening does not make headlines, but it slows activity behind the scenes. Now look at corporate earnings. Some sectors are performing well. Energy remains stable. Certain technology segments continue to grow, but profit margins are narrowing in consumer-facing industries. Retailers report selective demand. Discount chains outperform premium brands. Consumers are trading down. That is not collapse, it is adjustment. Business investment is another signal. Capital expenditures are no longer expanding aggressively. Companies are preserving cash. Hiring plans are measured. Expansion plans are cautious. When businesses hesitate, momentum slows. So where does that leave the economy? Not in recession, but not in acceleration either. This is what economists call a late-cycle environment. Growth slows, debt remains elevated, rates stay restrictive, confidence becomes fragile. The real question is not whether GDP is positive. The real question is whether the foundation is strengthening or weakening. Recessions rarely begin when everything looks broken. They begin when vulnerabilities accumulate. Consumer debt, high interest costs, slowing job growth, tighter credit, reduced flexibility. None of these alone cause a downturn. Together, they increase probability. Markets are watching the Federal Reserve. If inflation continues cooling, rate cuts may begin later in 2026. If rate cuts come too late, slowdown deepens. If rate cuts come too early, inflation could resurface. Policy timing matters. Global factors also matter. Trade flows, energy prices, geopolitical stability. The U.S. does not operate in isolation. External shocks can accelerate internal weakness. So, is America heading toward recession? The honest answer is this: risk has increased, but collapse is not visible. This is not 2008, it is not 2020. It is a slow tightening cycle, an economy adjusting to higher borrowing costs, an economy digesting years of stimulus, an economy transitioning from rapid expansion to controlled moderation. The danger is not panic, the danger is complacency. Strong headlines can hide fragile foundations. GDP measures output, it does not measure resilience. Unemployment measures jobs, it does not measure quality of employment. Stock markets measure liquidity, they do not measure household comfort. Recession is not a headline event, it is a process, and processes take time. Right now, the United States is walking a narrow path: growth on one side, pressure on the other. If consumer strength weakens further, risk increases. If labor stability holds strong, soft landing remains possible. 2026 is not a crisis year, but it is a critical year. The economy is no longer accelerating, it is balancing, and balance requires discipline. The next 6 to 12 months will matter. Watch employment trends, watch consumer credit, watch small business confidence, watch the Federal Reserve. Recession is a probability question, not a certainty statement, and probabilities shift slowly before they shift quickly. Understanding the difference is how you stay ahead. This is not about fear, it is about awareness. Because the economy rarely announces turning points, it transitions quietly, until suddenly it does not. If you want deeper analysis of the real U.S. economy beyond headlines, subscribe to Hidden GDP, because real economic shifts start small and become visible only after they are obvious.